interactive broker's Stock You program lets you earn extra income by lending out your shares from your account. On the website, they show an example. If you lend out 5,000 shares of XYZ with a market value of 375k, you can earn $16,875 a year leh. Now, that sounds very attractive. In this video, we'll be going through everything you need to know about the program. What is it? Who is eligible to join? How you can join? How much you can earn from it? And more importantly, what are the risks by joining? But first, in order to join the program, you will need to be using any of these interactive brokers versions. For example, IB LLC or IB Singapore. Then, you will need to have at least $50,000 worth of assets in your account. If you meet these two criteria, great! You can then enroll by opening up IB web portal, search for Stock You, click on it, click on the checkbox, click continue, and you are done. So simple! What's nice is that once you enroll, the entire process will be handled automatically by IBKR. So you can just sit back, relax, and start earning a passive income. Now, let me give a quick run through on how this whole lending thing works. After you have joined, IBKR will lend out your shares to third parties. And while your shares are being lent out, you will receive a cash collateral to secure the loan. This collateral can be in US Treasuries or in cash. And depending on the denomination of the stocks that's being lent out, you'll receive anywhere between 102% to 105% of the market value, rounded up to the nearest dollar or cents. And from there, you will start earning an interest. For every day the stock that's being lent out, you will earn 50% of the market-based rate on the collateral amount. Okay, I'm sure after hearing this, you'll be like, huh?
What did you say?
So, here's an example. Let's say you have 100 XSS shares, and right now the shares are worth $59.24. By lending out the shares, you'll receive 102% collateral. So, if you round it out and multiply it by 100 shares that you lend out, you'll receive $6,100 worth of collateral. Now, this particular share has an interest of 15% per annum. So, if you do a quick math, the daily interest on $6,100 worth of collateral is $2.54. And after the 50% cut, you'll finally receive $1.27. I'm sure by now, you'll be excited and be like,
Stu, you mean I can earn tons of money by joining the program?
Not really. That's because not all of your stocks will be lent out. Instead, only stocks and ETFs from the US, Canada, Europe, and Hong Kong are eligible to be lent out. And to be more specific, only stocks that are in demand will be lent out. And even if they are lent out, the money that you will earn on each stock may vary, depending on the demand and loan interest. But how will you know what stocks are in demand and how much interest you can earn? Unfortunately, you won't be able to check via the IBKR web portal. Instead, you will need to check via the Trader Workstation. To do that, open up either the Portfolio tab or the Favorites tab. Tap on Settings button on the top right hand corner, search for Utilization, click Add, then search for Fee Rate, then click Add again, then click Apply and OK. So what the utilization column tells us is what is the percentage of the shares that's being borrowed. Basically, the higher the number, the higher the demand. For example, we can see that Apple only has a 0.25% utilization rate, so there's not much demand here, whereas GameStop has a whopping 72% utilization rate. So if you own this share, it will likely be lent out. As for the fee rate, it's just the interest rate that's being charged on borrowed shares. For example, if your Nvidia shares are being lent out, you will earn a 0.26% interest divided by 2. Because remember, you will only earn 50% of the interest. So as you might imagine, if you are a normal investor and not a YOLO trader who are just buying normal shares, most of your shares won't be lent out. And even if they are lent out, you will earn very little interest. So just in case you are curious how much I've earned so far, here's how to check. In your IBKR web portal, click on Performance and Reports, Statements, Activity. Then click on the period that you want to check. Let's try Annual 2023. Then you can either click View or download to open up the report. After that, search for SYEP, and here you will see how much interest I've earned under the Stock You Enhancement program for 2023. If you add up the total, this is just 89 cents from a 300k to 400k portfolio size, which is ain't much, but it's honest work. Then, if you search for lent activity, you will see all the stocks that have been lent out during that period. For example, I've only lent out SPY and Square. But here's a question. Who is actually borrowing your shares? as it turns out, it's actually being loaned out to short sellers who are borrowing your shares in order to short the stock and profit when the stock drops in value. For example, recently, they had a record 1 week profit of $3 billion from the big tech sell-off. So then, isn't it bad to lend out your stocks? Technically, it is bad because short sellers can use your stock to push down the stock price. But if you think about it, if you are planning to hold your stock for the long term, your stock going down over the short term wouldn't really affect you, right? In fact, it is actually better for you if the stock goes down because it means you can now buy the stock at a cheaper price, right? Then you may be like,
No, shorting is evil. I don't support this.
In that case, just take a look at my lending activity. In April 2023, the most number of Square shares that I've lent out at any time is just 100 shares, and that is returned the next day. If that's the case, how much impact do you think my tiny 100 shares had on the stock price? Given that the average daily volume is 8 million units, I would say it's pretty minimal. Though, of course, when things get real, short sellers can indeed collectively bring down the stock price, assuming they don't get burnt when there's a short squeeze, of course. So then, the most important question would be, what are the risks for lending out your shares? There are 3 risks here. 1. When your shares are lent out, you lose the right to vote. And the voting rights now goes to the borrower who has your shares now. Now, of course, this by itself is pretty harmless, but in theory, this could be used in a bad way. For example, what if this short seller wants to short your stock and your company is holding a vote to see if they should pay the CEO or not? In that case, the short seller could vote in a way that's beneficial for them, which could harm your stock price. Now, of course, the chances of this swinging the vote in a direction is pretty low, but it could definitely happen in very rare cases. Second, when the stocks are being lent out and if you are being paid a dividend, you may receive a payment in lieu first and later on receive the dividend itself. And due to that, it will now be taxed as ordinary income instead of being taxed as dividend income. If you are from countries like Singapore and Malaysia, this has no effect on you, as you are still being subjected to the usual 30% withholding tax. But if you are from countries like the US, where dividends tax have lower rates as compared to income tax, you could end up paying higher tax on dividends that are being received via payment in lieu. Some brokers like Fidelity compensate you back for extra tax. However, IBKR, unfortunately, currently does not have a compensation plan. However, IBKR will still try to avoid allocating payment in lieu on best efforts basis. But based on my report, it can still happen. But perhaps the biggest risk of them all is that the borrower ends up being unable to return your shares back to you. This could happen in very extreme situation when the borrower loses a lot of money and is forced to shut down. And to add on, stocks that are being loaned out are not insured under SIPC. However, the good news is that there are a few protections in place because 1. Counterparty risk is solely against interactive brokers, meaning if the borrower is somehow unable to return the shares, it is IBKR's responsibility to return the shares back to you. And here, it is super important to find out how safe IBKR is. So far, they have been growing pretty strong, with net income, client accounts as well as total client daily average revenue trades all going up pretty steadily. And based on the latest earnings results, they have about $4 billion in liquid cash on hand, another $29 billion in cash segregated for regulatory purposes, and another $29 billion in securities set aside for regulatory purposes. To add on, 99% of their balance sheet is comprised of liquid assets, so they can liquidate it if ever it is needed. They have no long-term debt, and their short-term borrowings is just $14 million, which is pretty low. And while their other payables section is rather high, this is just their usual business operation, such as commissions, interest, and so on. So based on all these numbers, I would say that IBKR is in a rather safe position. Otherwise, another safeguard that could come into play is IBKR restricting trading on certain volatile stocks. This could help to reduce short selling and the risk of some companies getting short squeezed into oblivion. But let's say in a worst case scenario, IBKR did indeed keep up boom and close the shop, your last protection would be the collateral that is sitting in your accounts, which you can then convert back into cash. Though, the risk is that you won't be able to get back exactly the amounts that you have loaned out because the value of the collateral is only marked to market, aka updated at the end of the trading day. So those are the risks of joining the Stock Yield Enhancement program. Personally, I feel that the risk is small, but it is still a non-zero risk, yeah? Finally, here are a few more answers to the questions that you may have. 1. Can I terminate the program at any time? Yes. But once you unenroll, you won't be able to enroll again for the next 90 days, yeah? 2. Can I sell my stocks that are being lent out? Yes. You can sell your stocks at any time. Lending out your shares won't affect how you trade. 3. How will covered call affect my stocks that are being lent out? Again, you can write calls against the stock even if it's being lent out. And if the call is exercised and your stock gets called away, IBKR will automatically close the loan after T+1 days. So that was a quick video on how the IBKR Stock Yield Enhancement Program works. Let me know if you have any more questions and I will try to answer them. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.